Hey everyone, welcome back to Corporate Decoder, the place where we turn complicated corporate documents into something you can actually understand. Today we're diving into a report from Mitesco, and let me tell you, it's a bit like watching a magician try to escape a financial straitjacket. There's some debt disappearing, some stock appearing, and a whole lot of hope in the air. We are looking at a Form 8K, which is basically a corporate breaking news report. Companies file these when something big happens that investors need to know about right away. In this case, it's all about restructuring their debt, which is basically trying to get their finances in order. The date this all happened was April 24, 2025. Keep that date in mind because it's the day Mitesco started making some major changes to their financial situation. So what exactly did they do? Well, it all boils down to what's called entering into a material definitive agreement. That's just fancy corporate speak for making a really important deal that everyone has to stick to. The company is working hard to restructure its debts. It means they're trying to find ways to pay off what they owe and maybe even get some of that debt forgiven. It's like trying to renegotiate all your bills to make them more manageable. On April 24, 2025, Mitesco made deals with two of its creditors. A creditor is someone who is owed money, and Mitesco made a deal to give them something other than cash to pay off some of their debts. Instead of paying cash, Mitesco is giving these creditors shares of its stock, specifically 75,000 shares to each creditor. So that's 150,000 shares in total, but there is a catch. They are restricted common stock, which means the creditors can't just sell them right away. There are some limitations on when and how they can sell these shares. By giving away these shares, Mitesco is getting rid of about $600,000 in debt. It's like trading something you have for something you owe. For the purpose of this deal, each share of stock was valued at $4 each. So if you multiply 150,000 shares by 4 data points, so you get that $600,000 figure. Here is some extra good news from Mitesco. Everyone involved in this restructuring has agreed to cancel their warrants. Warrants give the holder the right to buy stock at a certain price in the future. Cancelling them means these people won't be able to buy more stock at a discount, which is good for the existing shareholders as it avoids diluting the value of their shares. Mitesco promises to try and register these shares so the creditors can sell them. They have to file paperwork with the SEC, which is the government agency that oversees the stock market, and get it approved. The company is hoping to get this done within 120 days. The company believes that they will have a substantial gain. In plain English, this means that getting rid of the debt this way will make their financial situation look a lot better on paper. Remember, it's all subject to their auditors agreeing with their accounting. Auditors are the people who check the company's books to make sure everything is done correctly. If you want to see the actual legal documents where Mitesco is agreeing to all this, it is there. Now let's look at this section about unregistered sales of equity securities. That just means they sold some stock without going through all the usual steps of a public offering. Mitesco issued shares of common stock as part of this whole debt restructuring plan. They sold these shares to a mix of accredited investors who are rich people and big institutions that are allowed to invest in riskier things, and non-accredited investors who are just regular folks. They didn't do a public offering where anyone can buy shares. They used a special rule that lets them sell shares privately without all the red tape of a public offering. Mitesco also gave some shares to their directors as compensation for their work. They used a rule called Regulation D, combined with that same Section 4AM2 rule to do this without a full public offering. Before we move on, let's talk about forward-looking statements. This is a standard disclaimer that companies include in their reports. Basically, Mitesco is saying that they're making predictions about the future, but those predictions might not come true. Words like may, will, expect are all clues that they're talking about what they hope will happen, not what they guarantee will happen. There are risks and uncertainties, and things could turn out differently than they expect. So take everything with a grain of salt. Finally, we have the exhibits. These are just the actual legal documents we talked about earlier. Zoom out and look at the bigger picture. Mitesco to turn things around, trying to escape their debts in creative ways. This move of swapping debt for shares can be a double-edged sword. If the company does well, the new shareholders get a piece of the action, which incentivizes them to support the company. If the company struggles, these shares become less valuable, and it might not have been worth it for the creditors. They seem to be betting on themselves, saying this move will improve their financial situation, and that they will have a substantial gain, which is corporate speak for a big improvement on the balance sheet. That depends on the auditors agreeing with their methods, of course. The warrants being cancelled is a definite win. Less potential dilution means the existing shares are a bit more valuable. However, there are a couple of risks that stand out. The first is that the company needs to get those shares registered with the SEC, so the creditors can actually sell them. Government paperwork can take time, and there's no guarantee it'll be approved quickly. Also, even if the shares are registered, there needs to be a market for them. Will people actually want to buy Mitesco stock? And will there be enough buyers so the creditors can sell their shares without driving the price down? In conclusion, Mitesco is trying to pull off a financial maneuver to get rid of debt and clean up its balance sheet. This could be a positive step if everything goes according to plan, but there are still risks and uncertainties ahead. It is a high-stakes game, and we will have to see if Mitesco can make it pay off. And that's all for today's episode of Corporate Decoder. If you found this breakdown helpful, don't forget to like, comment, and subscribe for more deep dives into the world of corporate finance.